Say Sean Builders or Sean Builders has borrowed a sum of rupees, US dollar 10 lakhs at the beginning of financial year 1950 for its residential project at 4%. The interest is payable at the end of financial year at the time of availment. The exchange rate was 56 per US dollar, and the rate as on 31st of March 2020 is 62 per dollar. If Sean Builders had borrowed the loan in India in Indian rupee equivalent, the pricing of the loan would have been 10.3%. You are required to compute borrowing cost and exchange difference for the ending 31st of March 2020 as per applicable accounting standards. So I would like to take up this problem. So question number 1 on 13th March weekend class. The first question is on 2 AS 16 borrowing cost. Borrowing cost would mean interest on loan taken, which includes commitment charges, amortization of premium or discount on bond, and includes exchange difference also. Exchange difference to the extent of borrowing cost. So a test is made only to find out what is the exchange difference that can be taken up as borrowing cost. Borrowing cost can either be capitalized or it can be expensed. We are not getting into the treatment here. We are just only trying to find out how much of the exchange difference can be regarded as borrowing cost. For this matter, if we take up the problem, we have understood that they have borrowed 10 lakhs US dollar. At the beginning of the year, loan available. $10 lakhs US dollar. Then, at the end of the year, interest accrual at the rate of 4%. So this we will make it out as 4% on that being 40,000. Closing loan amount is 10,40,000 in US dollars. So now the exchange rate, when we check up, is 56. So INR loan is going to be 10 lakhs into 56. So the amount comes to 560 lakhs of INR. At the close, it came to 62. 10 lakhs 40,000 into 62. 644.8 lakhs. Can we consider the difference in the loan amount? Difference in the loan amount. How much is that? Is it 84.8 lakhs? Can be considered as borrowing cost. Can the exchange difference be taken up as borrowing cost? Is the question. Now, difference cannot exceed notional INR borrowing cost. Borrowing cost is 10.5% into 560 lakhs. And 105 into 560. 58.8 lakhs is the maximum amount that you can take it up. Had you borrowed in INR, this much would have been the borrowing cost and not 84.8. So 84.8 lakhs can be split into two. So you take it up as borrowing cost 58.8. The balance exchange difference shall be expensed. How much is that? 58.8 on which this becomes 26. So this has got to be taken for capitalization process. If all other criteria were all correct, this one should be taken for P&L account expense. Okay. See, it is not that any difference can be taken up as borrowing cost. So you have a cap. So borrowing cost, had it been INR loan. Had it been INR loan, borrowing cost would not have exceeded 58.8. So that much you can take that. So imagine, just for the sake of argument, if the same 56 were to be there, just for argument's sake. So 10 lakhs 40,000 into 56. So this comes to a number as 582.4 minus 560. 582.4 minus 560 would mean this comes to 22.4. Whether 22.4 or 58.8, that can be taken up as borrowing cost. So only to the extent of 22.4. So therefore, what is that we should understand? So in simple, you can say the exchange difference or interest on equivalent INR rupee loan, whichever is lower will be taken up as borrowing cost. Between the two, whichever is lower should be taken up. So $26 lakhs, you just see 26 lakhs. So ultimately our institute is doing RTP instead of touching the nose like this. They are calling it and doing it like this. So therefore, just don't take the entire presentation like I say you just understand the spirit and you will get it. So question number 2, yes. Kapadam Mandana, yes sir. Okay, thank you. So Paridhi Electronics Limited invested in the shares of Dhanshuk Limited on 1st May 2020 at a cost of 10 lakhs. 3/4 of this investment were current investment and the remaining investments were intended to be held for more than 1 year. The published accounts of Dhanshuk received in January reveals that the company has incurred cash losses with decline in market share. And investments of Paridhi Limited may not fetch more than 7.5 lakhs. The reduction in value is apparent to be non-temporary. Non-temporary means permanent. You are required to explain how you will deal with the above financial statement of Paridhi Electronics as on 31st of March 21 with reference to AS 19. So now let us just take up the case for under AS 13. So investments are classified into two. current investments and non-current investments. Current investment where you have the intention to sell within 1 year from the date of purchases. Here, intention to sell beyond, or you can tell in a very simple fashion, other than. Correct. That makes the matter easier. So upon purchase itself, you can classify as current or non-current depending upon the intention that you have. It is not after the purchase of 1 year you think that it is current or non-current. Upon purchase itself, you can do that. Current investments are to be valued at cost or fair value on the reporting date, whichever is lower. In the case of non-current assets, it is generally at cost. Generally at cost, but when the decline in the value of investment but when the decline in the value of investment is non-temporary, it shall be valued at fair value, that is less than cost. This is the brief understanding that you got to have as far as investment is concerned. Now you know that they have got it for investments, 3/4 and 1/4. 3/4 are current. Now the published results of Danshuk revealed losses, and now this investment's fair value is 7.5 lakhs. So 3/4 of that 7,50,000, it comes to fair value is 5,62,500. 1/4 187,500. Correct. This is question number 2, in which you can say that investments are of 2 types: current investment and non-current investments. At cost, 7,50,000 and 2,50,000. Total is 10 lakhs. Their fair value being 562,500, and it is 187,500. Total is 7,50,000. How to deal with the above scenario? So value, cost or fair value, whichever is lower, 562,500. Generally at cost 2,50,000, but in this case you can't take it up because this 187,500, which is considered to be non-temporary in nature, and the value of this being 7,50,000. This is the stage at which it should be evaluated. And of course, the difference being diminution in the value. What is the definition? Diminution 7,50,000 and 562,500. 187,500 and it is 62,500 to be transferred to P&L account. Same is the case for non-current investment. So question number 3, ABC Limited received 2 acres of land receipt for setup of plant. It also received 2 lakhs receipt for purchase of machinery, rupees 10 lakhs, useful life 5 years. Depreciation on this machinery is to be charged on straight line basis. How should ABC Limited recognize these government grants in the books? Until this item is read, we are not knowing that whatever information they have given initially were all government grants. Sometimes it so happens that way. So where the clarity comes only towards the end, until such time confusion will only be provided. So they received 2 acres of land for setting up a plant is a government grant. That is what you have to understand. Then 2 lakhs of rupees for purchase of machinery. There are 2 government grants that you have. Government grant is done in AS 12. Question number 3. Grant. One is land, the other one for PPE, machinery. So type of grant is that this is non-monetary, that is in kind grant was provided. Here it is cash. So ABC received 2 acres received would mean what price they have paid we do not know. So fair value also not given. So now we have got to assign reason. So how much paid for land is not known. How much paid for land is not known. That is concessional price or given as free. Or given as free. So if given on concessional basis, if given on concessional basis, account at actual cost. Okay. Supposing fair value is 10 lakhs, 8 lakhs, and cash paid is rupees 1 lakh. Then account land at rupees 1 lakh. If given on free basis, then account at nominal value, say rupee 1. At rupee 1, you debit land and building credit is to be given to government grant. So since land is not a depreciating asset, we are expected to offer credit to profit and loss account based on the cost of those conditions given that they have incurred. So no government grant will be given without conditions. Cost of meeting condition may be the base for, in this particular case, it will not be like that because it will be a nominal value. Nominal value 1 rupee. Okay, this we have taken up. Account land only at rupees 1 lakh. Then machinery, cash, rupees 2 lakhs. There are two approaches that we have. Approach one. What is the approach that you got to do? Approach number 1 is show asset at gross rupees 10 lakhs and show government grant at rupees 2 lakhs. Charge depreciation based on 10 lakhs on straight line basis to P&L. Charge depreciation based on 10 lakhs on straight line method to P&L. Credit to P&L in proportion of depreciation. Correct. That is, in the balance sheet, PPE 10 lakhs, liability side government grant 2 lakhs. In P&L account, they mentioned that useful machinery life is 5. So, 2 depreciation 2 lakhs, 10 lakhs divided by 5 by government grant deferred income, 2 lakhs divided by 5, 40K. This is approach number 1. Approach number 2. Show government grant as a reduction to the cost of rupees to the as a reduction to the cost of PPE. Charge depreciation only on the net. What do you mean by that? What is that we should do? In the balance sheet, PPE will be taken up as 10 lakhs in inner column. There is government grant 2 lakhs. Outer column 8 lakhs. Depreciation, there is P&L account. $1.6 lakhs. The net effect in these cases will remain the same, 1,60,000. These are the two approaches that you have for government grant. ABC Limited is setting up new refinery outside city limits in order to facilitate construction of the refinery and its operation. ABC is required to incur expenditure on the construction and development of railway siding, road and bridge. Though ABC incurs the expenditure on the construction and development, it will not have ownership rights on these items. They are also available for use to other entities and public at large. Can ABC Limited capitalize expenditure incurred on these items of property, plant and equipment? See, now let's just have a look at this question on screen. say, in their own interest, this refinery had constructed siding and road and bridges for safe passage of oil before refining and after refining. It is their own interest that they have just done. It will not have ownership rights on these items because these roads, sidings, and bridges are not private property. They are open for public. So quite naturally, the public will have access and therefore it should be owned by the government. On government property, there is land, the siding, roads, and bridges were constructed by the refineries for their own benefit, but they can't deny access to other users. Whether this money that they have spent in constructing and developing sidings, road and bridges be taken for capitalization is the question. So before I could just communicate the final answer, let me find out from you. What is your stake on this? Come on. I have asked you a question. You can take a minute's time and answer to that.
So they can be capitalized at and the long run they will be getting the benefits of it.
But ownership concept is missing, no? Whether you will be in a position to have a control on that. Say, whatever future economic benefits you are having, are you having control on that? Have you understood my question? It is not an exclusive usage. That is what they say. They are also available for use to other entities and public at large. You can't construct and make it as a private property. So if it were to be a private property, control aspect is there. Now let us just see. AS10 states that the cost of an item of property, plant and equipment shall be recognized. If future economic benefits associated with that is resulting to the entity, the cost of the item can be measured reliably. Further, the standard provides that the standard does not prescribe the unit of measurement for recognition what constitutes as a plant and equipment of property. Thus, judgment is required in applying recognition criteria to an entity's specific circumstances. The cost of an item of property, plant and equipment comprises any cost directly attributable to bringing the asset to the location for it's capable of being operated in the manner intended by the management. In the given case, railway siding, road, bridges to facilitate the construction of the refinery for its operation. Expenditure on these items required to be incurred in order to get future economic benefits from the project as a whole, which can be measured as unit of measure for the purpose of capitalization of the said expenditure, even though the company cannot restrict the access of others for using the assets individually. It is apparent that the above aforesaid expenditure is directly attributable to bring the asset to the location and condition necessary for its capable of operating in a manner intended by the manual. In view of this, ABC may not be able to recognize expenditure of these assets as an individual item of property and plant and equipment in many cases, whereas it cannot restrict others from the use. The expenditure incurred may be capitalized as a part of overall cost of the project. From this, it can be concluded that in the given case, the expenditure incurred by the assets should be considered as cost of constructing the refinery, and accordingly, expenditure on these items should be allocated and capitalized as part of the items of property, plant, and equipment of refinery. See, what exactly is the conclusion that they made? The road, bridge, the sidings cannot be identified as an asset by the same name, but the expenditure what they have incurred is likely to generate benefits to refinery, and therefore there is no two opinion regarding capitalization, but you can't put it in the name called sidings, roads and bridges because you don't own it. But in the construction of refinery, you would be having lot other PPEs, lot other property, plant and equipment. On some rational basis, the expenditure incurred in bringing a pathway for refinery can be taken for capitalization, but not in the name of sidings, bridges, and roads.
Question number 5. The inventory of Rich Limited as on 31st March 2020 comprises of product A 200 units and product B 800 units. Details of cost for these products: product A, material cost, wages cost, and overhead cost of each unit are rupees 40, rupees 30, and rupees 20 respectively. Each unit is sold at rupees 1. Selling expenses amounts to 10% of the selling cost. Product B, material cost and wages cost of each unit are rupees 45 and rupees 35 respectively, and normal selling rate is rupees 150 each. However, due to defect in the manufacturing process, 800 units of product B were expected to be sold at rupees 70. You are required to value closing inventory according to AS2 after considering.
See, now let us just have a quick look that they are having two products, product A and B. The quantities being 200 and 800. Details of the cost where, as far as product A is concerned, material cost, wages, and overheads are 40, 30, and 20, summing up to 90. Each unit is sold for 110, selling expenses being 10. So if you take up the concept under Ind AS 2, cost or NRV, whichever is lower, is applicable only for finished goods. What they are telling about is a finished goods. So it will cost them 90 rupees if they manufacture. The NRV for that being 110 minus 10, 99 it will become. 90 or 99, whichever is lower, if you ask a question, 90 is the answer. So such a figure of 90 to be multiplied by 200 should give you 18,000 as the value for product A. So now let us just take up for product B, material cost and wage cost being 45, 35. Total of that comes to 80 rupees. But the normal selling price being 150. But however, there was a defect in manufacturing process, 800 units were expected to be sold for 70. That all that 800 are defective ones only. So that can be sold at a price less than the normal cost of 80. That can be sold only for 70. So 70 is lesser than 80. Now product B has got to be taken up at NRV. So 70 to be multiplied by 800. The answer is expected to be 5,600 or 56,000. So that is a way we will be taking it up. Now let us just work out. Question number 5. Product A, material, labor and overheads. What is the difference? Net realizable value 110 minus 10% to be 99. Whichever is lower, 90. Number of units 200. So stock value is 90 into 200, 18,000. Product B. Cost. Material and wages together 80. Wages 35. NRV, they themselves are given that it is 70. So value is cost or NRV, whichever is lower. 70 the NRV. Number of units 800. Value of the stock is Rupees 46,000. 18,000 and 56,000. Total value of that inventory is 74,000. Vital Limited borrowed an amount of 150 crores on 1/4/2019 for construction of boiler plant 10%. The plant is expected to be completed in 4 years. Since the weighted average cost of capital is 13%, the accountant of Vital Limited capitalized 19.5 crores for accounting period ending 31/3/20. Due to surplus fund of 150 crores and income of 1.5 crores was earned and credited to P&L account. Comment on the above treatment with reference to relevant accounting standards. So it is a problem involving treatment of borrowing cost, especially when you have a specific borrowing as per AS 16. They borrowed 150 crores and average cost of capital is 13% is not an important information because what is actual cost is only 10% on 150 crores. So that comes to 15 crores. And the surplus funds out of 150, 1.5 crores they have earned and credited to P&L account. That has got to be deducted. That is what I said. The weighted average cost of capital is not required. So 15 crores is the gross. Income from temporary investment is 1.5. Borrowing cost to be capitalized is going to be 13 lakhs and 50,000. Is that clear? That weighted average cost of capital is no important information. They have capitalized 19.5 and all that is not correct. Specific borrowing 10% on 15 lakhs. Then 1.5 crores, that much we will be deducting. The remaining portion alone will be taken for capitalization. Are you clear?